indexes are going to get hammered because of interest rates in the next cycle. When rates go up, PE multiples go down. So the broad indexes are not going to do well in that environment. You will want to be in stocks that can outpace inflation, and that's the biggest sector for that is commodities. Energy stocks could go up tenfold. Who knows? I mean, if oil goes from 30 to 500, there's going to be a lot of money made in the fossil fuel industry. If gold goes to 20,000, even a gold mining company is going to be able to produce results with that. When you get the kind of moves you get in the metals, even poor managements can make money.
This is Little by Little with Andy Schechtman.
Good morning, everyone. Welcome back into another episode of Little by Little. I'm honored to have with me David Hunter, the Chief Market Strategist at Contrarian Macro Advisors. David, thank you for jumping in with me today. It's nice to see you.
Yeah, thanks, Andy. Great to see you.
Likewise. I will jump right in and get started in respect for your time. These discussions, largely because they seem to go on and on. I like the conversation. Seem to go longer than I anticipate. So we'll jump right in. You know, there are a lot of people who have differing opinions on inflation. I've done interviews recently where some people say inflation is under control and others say it's just getting started. You've said inflation is largely under control now, or you anticipate it starting to trend downward. But in alternative measures, like my good buddy John Williams of Shadow Stats says, it's still running much higher, closer to 9%. How do you reconcile that difference, and how do you think the official numbers are missing something important?
Yeah, I don't know how Shadow Stats is coming up with that number, but clearly, obviously, there are, you can look at everyday prices and in some respects question whether inflation's coming down. But I think ultimately, using any of the official numbers, using even Trueflation, the signs are there that we're still in a downtrend. We've been downtrending, for 2 years. And I continue to expect that trend to continue. I think a lot of it is people, and certainly not Shadow Stats, but there are lots of people out there that mistake price levels with inflation. Price levels are high. They're not going to, go down a lot. But actually the numbers, I believe the numbers, and the numbers are showing that we came down a lot from 8 or 9% down to 3%, a little below 3%, and kind of stalled at a plateau there. And people started worrying about the 1/10 tick ups over month to month over the last few months. People take that as if, oh my God, inflation is breaking out again. These things are not straight lines. They're not linear type things. And as far as I can see, the economy is still soft. We have a have and have not economy. The have part of the economy is doing fine, but there's a big chunk that's a have not part of the economy that's just getting by. And I think we're going to continue to see the economy slow. And the other thing that's out there that I think people are, certainly the Fed is concerned about, and lots of investors are concerned about, is tariffs. And I think people misunderstand tariffs in terms of how they impact inflation. They are kind of a one-time or one-off bump up in inflation, but in terms of the trend, they will cause a slowdown, if anything, in demand, and ultimately will kind of bring that inflation back down again. So I think this idea that because tariffs raise prices, that's inflationary. It's a one-off, and it doesn't add to the trend. So all in all, I'm actually out there saying that we're still in a downtrend in inflation, but more importantly, we're headed for deflation.
Yeah, that's interesting. And always think of gold in that respect. Most people think gold is only for inflation, but there are guys like Roy Jastrom who have surmised that actually gold performs best in a deflationary environment, in the context that it has no counterparty risk in a period of more difficulty in servicing debt, and I guess it will be interesting to see how that all plays out. I've always wondered how the inflation deflation debate ultimately plays out, but I respect your opinion for sure.
Yeah, I don't actually think deflation is going to last all that long. As you know, I'm sure I'm calling for a global bust. I define a bust as something that feels like a depression, but it's in the time frame of a recession. So, it might be 12 to 18 months. Halfway through it, you might actually see deflation, across the board, not just in assets, not just in commodities, but our inflation numbers, our index is showing some deflation, but it's it's not going to last very long. It's not a depression type deflation. And I do think the metals will probably get hit. We can talk about this later, but I think the metals get hit in the bust for sure. So I'm not sure they're going to really be much of a hedge against the bust or the deflation, whatever you want to focus on there. But I do understand. Yeah, they will hold up better than equities, for example, and be some sort of a hedge. But I still think most assets in this bust are going to get hit.
Yeah, I'm going to get to the bust. I know that you have done a little bit of digging and watching of your videos, of course, and as I follow you regularly, and you talk about this massive deflationary bust followed by a big inflation spike. But you also predicted a massive market meltup, with the S&P possibly hitting as high as 7,500, the NASDAQ 25,000. The Dow Jones 55,000. I believe you expect this first, if I'm not mistaken. And this is driven by investor excitement and speculation. What makes you confident we're going to see that kind of move first?
Yeah, so I was calling for that going back to the prior to the bottom in October 22. So I was talking about, I think initially my target was 6,000 back then. I raised it to 7,000 the beginning of last year, and raised it to 7,500 several months ago. And so the hard part's been done. As you know, back in October 2022, most people thought we were heading south of 3,000. And I was very bullish in saying, no, I think, people are way too bearish and the sentiment's way too negative, and called for that big rise. So the hard part of going from 3,500 to 6,000 has already happened. I think the final, what I call the final leg of a 43-year, what I had called a 42, now turning into a 43-year secular bull market that started in August of 1982. I think that final leg is going to go parabolic. So that's really the case I'm making, is that I think we just finished a consolidation here, gapped up yesterday. Whether we fill that gap or not, I think the lows of, the week before last are probably in for this consolidation. And I think you're going to be off to the races here in the next month, 2 and 3. So you could cover, as crazy as it sounds, you could cover that ground from, wherever we are now, 5,700 up to 7,500. You could cover that in a few months. Don't know if it'll go that fast, but that's what a parabolic is all about, is covering a lot of ground in a hurry. It's exciting, but it's also the last stage of a very long bull market. And what comes on the other side of that is what people really need to understand.
Right, and I'm going to get to that. That's the scary part. I think part of your thinking also kind of coincides with what you believe the bond market has to say about all of this. And I found it interesting. One of the things that that I really wonder how it would play out, at least in terms of the value of the dollar and the demand for the treasury market, is your belief that the 10-year yield curve could rise to about 4.5%. And I looked this morning, I think we were about 4.3% or real close to 4.3 on the 10-year. But you think that this will roll over to as low as 2.5%. That's a massive drop. I'm assuming this is what accelerates this market melt up first. So what's the timeline you see for that huge drop in the 10-year yield? But my question, David, would be, what impact do you think that has on the dollar and in particular the broader treasury market, which due to weaponization and volatility has had a hard time attracting demand globally? How does this all play out in your mind?
Yeah, so just to start it off, I've been talking about in the last couple weeks, probably the last 2 or 3 weeks. There's a short-term head and shoulder top in rates. Up on the 10-year, up around there's a gap at 440, and the right shoulder goes up to 450. So somewhere, I've been saying between 440 and 450 looks like a kind of a likely place where this thing would roll back over. As you know, we got down under 420, and I had a lot of people saying, I guess that call's wrong. I said, it doesn't look like it's finished yet. Give it time. It did get up to, I think, 436, maybe 7 this morning. And so, you're within a few basis points of that gap. Whether it fills it or not, it could roll over here, and everybody's sitting waiting for that. So I'm not worried about whether the last 10 basis points happens or not. The bigger story is exactly what you said. I think we are going to see through the spring and into the summer a decline that will take us down to 3% and below. I think 2.5 looks like a pretty good target. And that will come, I believe, with the reality that the economy is, if not in recession, pretty darn close, that inflation is coming down, and probably going to be at the Fed's target this spring or by June, and that the Fed's going to be back on the ease side. So I'm not one of those that gets caught up in the month to month or meeting to meeting. What's the Fed going to do today? What's the, what did the Fed say today about the future? As you well know, being a longtime follower of the Fed and the economy, you're not going to make a lot of money using the Fed's prognosis of what's coming, right? They're one meeting they can say we think we're not going to be cutting rates for the next, the balance of the year. And the next meeting, they might be saying, we think we're going to have 3 cuts. So, people act like those things are cast in concrete and that they're actually good forecasts. They're not. They're just like the market. They're a point in time reflection of what the thinking is at that point. And of course, I'm a contrarian, and those guys are pretty consensus. There's a lot of times where I'm going to be completely in disagreement. And I've been a big defender of Powell. I think he's managed what their mandate is. He's managed very well these last couple of years. If he did what maybe I thought or what the street thought, many of those times we'd be in a different place. He gets a lot of criticism, but frankly, he's been more right than anybody in terms of kind of trying to walk that line between, easing and not easing too much, and between, making sure that we bring inflation down, but without causing a recession. Now, I have a problem with what I think's coming, and that the Fed will be part of the error that causes that. But up till now, I don't know how you can be critical of what he's done.
Well, I think, there's always room for critique, and there's always differing opinions. That's one of the reasons I like having this show. And there's so many different opinions, and I think we all need to listen to both sides in order to, to formulate the correct answer. And it's tough. It's tough in this environment. The Fed has really somewhat of a very difficult mandate between inflation and a softening economy, and how to walk that line. I agree. you have said, to your point, that you're afraid of what you see coming. And in listening to some of your videos, I've noticed that you said you believe we'll see a crash even bigger than 2008 after this big market run. What makes you think we're headed for that kind of nosedive, and how do you see it playing out? And then I guess I'd also want to know, you see this big run up. Is this big run up a very, very short-term phenomenon, or how long before you see the tide really turn in favor of this big deflationary bust?
Yeah. So I think we could be in recession as we speak. Maybe not. We'll only know after the fact. As you know, the NBER goes back after recession is over and dates it. So lots of times I can remember through my 51-year career how many cycles we thought the recession started here, and it started many months before that. So, it's hard to know whether we're in recession now or not, but we clearly are seeing signs that a good chunk of the economy is slowing down. And whether it starts now or starts by summer, I think we're heading for a recession. And then the recession then morphs into a bust, simply because, at least my thesis is, we have 320 trillion in global debt. We have a pandemic that caused, even though we're looking, everybody's kind of forgotten about it and the economy looks pretty solid, under the surface, that pandemic did a lot of damage. So particularly in small business and places like that, but we're in a different world today, and certainly in this country, we're in a different place in terms of employment. These little, small mom and pop places have trouble finding people to work for them. I don't know what happened to the kids, but I'm sure you did. When I was a kid, we got part-time jobs, and now I've seen dry cleaners close and, other places close because they can't find help. I mean, and that's all since the pandemic. I don't know whether people got out of the habit of sending their kids out to find a job or what, but it's kind of an off conversation thing. But I do think under the surface, there's a very fragile economy. And we look at the statistics, you and I and people in our business, we look at the statistics and things look sound. But really, there's, it is part of that have and have not economy story. There is a lot of fragility in the system. So I think this time when we roll over, it's more fragile than in 2008-9. And then you add to that the fact that we're off the rails in terms of comparison to 2008-9 in terms of debt, whether it be sovereign debt or whether it be private debt. The leverage in the system is big. And I learned in business school long ago, leverage works to your benefit on the way up, but boy, does it hurt you on the way down. So, pretty simple thesis, but that's what I think can cause a normal recession here to turn into something worse. And then I add to that, I kind of put out a formula and I go, it's massive leverage plus economic fragility caused by the pandemic, plus central bank error, because keep in mind, this is a global bust, not just U.S. And I think we see it in conversation. We see it in comments from Powell. We see it from Lagarde. They are promising us they will not go back to what they did after in response to 2008-9. So you're on the verge of what I think with that leverage is going to be pretty nasty and starting to roll. And you're going to have these guys hesitant to provide the liquidity needed to stop it short of something disastrous. So they're going to ultimately have to do it. But that hesitation, that period of time while they're, it's not that they're not going to ease and they're not going to be putting QE into the system, but they're going to be doing it in measured ways rather than in the massive ways that they should be doing it to stop a free fall. So it's going to take them, and in this kind of a free fall, as we saw in 2020 and 2008, once things start going south, they can go south in just a matter of months, in a couple months. So a hesitation of 2 or 3 months or even weeks can make a big difference on how deep things can go.
I'm going to ask you about this deflationary bust and the commodity boom that you talk about, but you say something that makes me think, in 2008, the Fed's balance sheet was $800 billion, and by, a year into the pandemic, it was $9 trillion. Do you think that we actually see that type of Fed intervention before this is all said and done? And if so, what does that do once again for the demand for the U.S. dollar as the world reserve currency, and more importantly, the demand or lack thereof for the U.S. Treasury? I'd be curious to your thoughts before we jump into the major commodity boom that you see on the horizon.
Yeah. So basically, the response that has to come again. I call it's a matter of timing. It's not whether they will do it or not. If they're faced with a free falling system, this is, and again, it's global. So if the banking system around the world is free falling, they can't fight it for very long. They're not going to sit there and say, well, we promised we wouldn't go back and do QE like we did in the past. They're going to be deer in headlights, scared, saying we got to do something, right? So we did $5 trillion in response to the pandemic, and you're right, we were at $875 billion going into the financial crisis in October of 2008. So it's massive. We've gone from that to $9 trillion. Now we're down maybe to 7. Or slightly below. My estimate is that the response, and again, this is total seat of the pants guesswork, but I would not be surprised to see the Fed's balance sheet grow from where it is now to 30 trillion, so over 20 trillion. I always say this on Twitter when people start beating me up on it, and I'll go, I'm not endorsing this. I'm telling you it's inevitable. I'm telling you if I'm right about the bust, and we will see proportionally every central bank doing the same thing. So there's part of the answer to your question about the dollar is that we're not doing it in isolation. We're the biggest, so our numbers are going to be so much bigger. But it's going to be everybody's going to be throwing currency into the system at huge rates. I believe I have a forecast on the dollar of 82 for this year. So most of that I think comes before the bust, but part of the first part of the bust, I think the dollar can continue to go down because they'll be easing, they'll be doing things. I think later on the dollar gets a bid again because, as it always does in crisis, the world runs to the dollar as the flight to safety trade. So you can go down from 103 and change to 82, and then by the end of the bust be back up to, or early after the bust be back up to 120. I think we're going to see volatility in currencies like we have never seen.
Yeah, I wonder if one of these days the dollar loses that safe haven bid because of all of this. Reminds me of the wisdom of understanding the Cantillon effect. If what you say is true, people would do themselves a service by understanding the theory of the Cantillon effect. That is, he is closest to the money printer wins. It's about having assets, and in an inflationary environment, not holding currency, but holding assets, doing the best you can to acquire assets leading up to that certainly would be beneficial. You've said that we see a deflationary bust followed by a big inflation spike, with inflation hitting as much as 25%. And heck, if you see the Fed's balance sheet get as high as you just mentioned, 30 trillion, 25% may be conservative. And this is the Cantillon effect at work. This comes with a major commodity boom. Again, assets, real things. You see oil at $500 a barrel. You see gold at $20,000 an ounce, and silver as high as 500 now as someone who owns a gold company. I am not complaining about those numbers. Certainly, I wonder what the world would look like at those levels. Certainly what a McDonald's hamburger may cost. Anyways, can you break all that down, how you see that playing out? And again, just to put a little bit of timing on it, how much time do people have to start accumulating those assets before this major commodity boom?
Yeah, so I think commodities will get hit in the bust. So answer to that last question, I think there's time. There's going to be a run up here in commodities pre-bust because I have a target on copper of $6, and I've had that target when I was down under 4, and people thought I was crazy. But it doesn't look so crazy now, and it's not that far away now, given the moves we're seeing. So I think you'll see copper at 6 or a little higher. I think you'll see gold at 3,400, and I think that's conservative now. I'm beginning to think that I've got to raise that. My silver target is, and the part of the reason I think gold looks too low, I think silver's going to 75. These are all pre-bust. So then in the bust, you could have gold go back to 2,100 where it broke out. You could have silver go back to here or below from 75. And oil, I think, will go to 30 in the bust. So there's going to be a time here. As I say, people need to realize don't be a linear investor here and think that you can buy and hold and, ride it through a bust, because these things are very, obviously very economically sensitive, and they'll get hit. They may get hit less than the equity market because I'm calling for an 80% bear market, but they'll get hit. Then once that massive printing press response is in the system, there'll be a lag. Usually inflation, because you're coming from deflation, you're not coming from here. So there'll be a period to get back to even, because we'll be, markets move, as markets move a lot faster than the economy. So the market's going to start moving back up as a result of that money, and commodities are going to start moving up as a result of that money prior to when the economy's moving back up, maybe 6 months before. So you're not going to be off to the races and see, housing straight back up, or the economy, economic activity straight back up. So there's a lag to where you can actually be back in inflation. It might be, because of that massive money, it may come faster. I can remember way back, as probably before maybe you were on this, but there was a fellow named Stanley Burge, who was a technician with Tucker Anthony years ago. I sat with him at lunch one time in Boston, and he was an old GE engineer that went, kind of self-taught on technical analysis and became their strategist. I can remember him. This was back in the mid 80s. Showing me charts and showing me how, yes, there's maybe a 6 or 9 month lag to when money turns into activity, economic turn. But with inflation, he had it calculated at 18 months. And he had long charts to show. So inflation doesn't just come roaring back right back up. And that's, this time we're coming out of deflation. We haven't seen deflation really since the 30s, so 1930s. So it's a little uncertain how long it will take, because on the one hand, you're going to have so much money in the system, and we don't have the capacity that's going to satisfy the demand. So that could come pretty quickly. So it might be a year later you start seeing it, or it might, if because we're coming out of deflation, it might take more. My guess is, let's say the bust hits before the end of this year, and let's say it's 12, 15 month bust. You're talking about the bottom of the bust being the end of next year, maybe, around there, I would say. The market might turn middle next year, back up. Commodities, same thing. They'll turn up probably with the market. You might be in the first year out of the bust, you might be in 3-4% inflation. but you're going to quickly ramp up so that by the time we're at, say, 2028, you're approaching double digit if you're not already in double digit. And by the time you get to the 2030s, you're over, you're on your way to 20, if not over 20%. I think it's going to be a very fast move. And a lot of it is, keep in mind, we're having what I call the macro effect, the massive money responding to a massive unwind. But that's being coupled with a reshoring event that's going on, or reshoring cycle, where we're trying to bring industry back here after giving it away for 30 years. And, it's begun, obviously. We'll see semiconductors, we'll see steel plants, we'll see auto plants, we'll see a lot of things. All that requires commodities. So you're going to have this massive ramp up in demand. And what we've done over the last 20 or 30 years, really since the 80s, is we've been rationalizing down our capacity in commodities, right? So there's no, you can't just all of a sudden say, hey, look at the demand, we've got to ramp up our commodities. You've brought commodity production down and the capacity to produce down, so that when you get this massive spike in demand as a result of both reshoring and the massive money, you're going to have demand way outstrip supply, and that's why you get the price moves I'm talking about. It only, it blows itself, it burns itself out in 3 or 4 years probably, but in that period, it's going to be, there's going to be so much dislocation, it's not funny.
If a genie came out of the bottle, you go on a walk later this afternoon, and a genie comes out of the bottle and says, the bust begins tomorrow, and you say, in that environment, he who loses least wins. Where do people put their money tomorrow, knowing that there's a bust in commodities and in equities? Where's the only safe place to be in your mind during that interim?
Yeah, I think, and this is probably counter to a lot of people who are pretty negative about our debt and deficits, but I believe the Treasury bond will be king through the bust. I mean, basically, I'm not only calling for a 2.5% yield on the 10-year this year and probably by sometime this summer, but I'm also saying that from there in the bust, you're going to see a 10-year go to zero, and you're going to see short rates go negative, and everything in between will be zero. So long bond might get down to a half or a quarter, but what we're talking about is a yield shortage, right? Because you can have every central bank buying every bond in sight. They can't do QE without doing that, right? So that's instant demand. And at the same time, you can have institutions saying, I have nowhere else to put my money. I need that government guarantee. So it's going to be demand outstripping supply. Again, it's the end of a bull market that started in 1981 when rates were 15% plus. And we got down to, I think, 0.4 in the pandemic on the 10-year. And everybody and his brother has decided that that was the top of the bond market, right? A secular bull market. I believe there's one more leg down in rates, up in bonds, that takes you below that, in a spike. And then I think it's the end for bonds. I wouldn't want to look at a bond going forward from there, because if you're going to have 25% inflation, you don't want to own bonds in that environment. As I say, those that need to have fixed income in their portfolio after the bust should be rolling T-bills every 90 days or every 6 months at least. And that should be your fixed income portfolio, because it won't be fixed income. You'll be rolling at ever higher rates.
The one thing I applaud about you is your courage to be unique. I haven't heard many people have your take. I see the logic in all of it, much of which I agree with. Some of it, I guess we'll just have to see how it plays out, but I appreciate someone who has an opinion and isn't afraid to voice it.
Yeah, it's people can misunderstand because these are I'm not throwing these out to be hyperbolic. I'm not throwing them out there because it's my personality to get caught up in this. It's really where we are in the super cycle and what we've done all these years is why I think we can do this. Am I going to be correct to the extremes that I'm talking? Who knows? We'll find out. But
Okay, 50 years in the industry gives you the right to be able to make these statements, and that's what it's all about, is listening to various viewpoints, taking it all in, and figuring it out yourself, because in many respects there's no playbook for where we're at. I respect it very much, and for one, I think it's important to listen to all of this and formulate your own opinion. But, I guess if you're like me at all, you start to wonder sometimes, at least maybe not to the degree that I have. I'm a little bit more contrarian in a different sense of the word. You get caught up in this, I don't even want to call it doom and gloom, this balance between what is reality, what is pessimism, or realism. And, but I try and find some glimmer of hope and of optimism. So with that being said, let's end on a positive note. Where do you see room for optimism in the next few years? What are the sectors or the trends or the shifts? I know you've talked about all this, but if you're going to sum it up, where do you see the most, whether it be expected or unexpected opportunities or even market resilience? Where would you tell people to focus who are trying to figure out what's the best way for me, an average person, to just, not only survive what's coming, but maybe even get ahead and thrive?
yeah, I'm gonna talk a step before that, before I get to that, and just say, even though I'm talking a bust happening potentially this year by the end of, probably fourth quarter, if it's going to happen, we are in an unusual place. I'm saying this is we're nearing a top of a 43-year secular bull market. Normally, I would be telling people, nobody's that smart. There's the other side of the mountain is what you should be concerned about. So, don't think you're so smart that you can call it right up to the top, because you won't. You'll get it wrong. That's almost guaranteed. However, because so many people have gotten so negative here, and really have fought this whole thing since October 22, they've just been worried about the other side of this forever. You've got a lot of bear sentiment out there. And if I'm right, I'm calling for, if you do the numbers, 35% to, with the Russell, as much as 65% between now and the top, which I think could be this summer. Those are numbers that you normally earn in 2 or 3 years if you're lucky. And if you got 5% interest rates, you normally earn that in, it takes you 4 years, So it's a rare period where you can earn years worth of returns in a few months. And if you say, well, I'm not that smart, I'm gonna, I want to be safe, I'm gonna get out now. Just understand yourself, because what's going to happen is the nature of psychology is, if you get out now and miss 30 or 40%, at the top, you're going to buy into all the rhetoric that's going to be out there in the euphoric time you're going to have at the top, telling you this cycle has years to go, that, the Fed's on board and this thing's just getting started, and you're going to jump right back in at the top. So I would just caution people, be a little careful, because even though I'm calling for a top in a matter of months, it's going to be a tricky thing to get this right. Now, to your real question, which is, what do you do in the bust and beyond? In the bust treasuries, as I said, make sure if you're in the bank, you're in an FDIC insured account, because the government will have the printing press and they will fund the FDIC to whatever they need to. They're also probably, I can't guarantee this because we don't know, but they had the don't break a buck on money market fund back in 2008. I'm sure that will come back, because they're going to have to pull out all stops to make sure they hold this thing together. I don't know what they'll do with pension funds, because there's a lot of risk in pension funds, now that they've upped the ante and bought all kinds of private equity. Private equity in the good old days, back in the mid-'80s, were known as leveraged buyouts. So in other words, private equity is a lot of leverage. You don't want leverage in a bust. So pension funds are going to get hit hard. Endowment funds are going to get hit hard because they all decided private equity is safer than public equity. We're going to go there. It isn't, not in the bust. So coming out the other side of the bust, as I said, it's going to be a huge commodity cycle. And this is true of every cycle. Every cycle has different leadership. This cycle was tech and healthcare and financials maybe. Next cycle is going to be commodities and industrials. The consumer is going to be digging out for a long time if my scenario comes true. They're going to get hit in their housing. I think housing could drop 30-40% in the bust. They're going to get hit in their stock market portfolios because I think you could have an 80% bear market. They're going to get hit. Obviously they're going to be digging out from losing jobs, etc. So housing is not an inflation hedge. Housing, if interest rates go from, you could see a 2% mortgage during the bust. If it goes from 2% to 20%, real estate values are going to go the other way. So people who think real estate is going to be like it's been for the last 40 or 50 years, I don't think so. So the areas that you really want to be in are going to be commodity oriented things, both companies and things that can outpace inflation. And inflation is going to be pacing pretty fast. So that means precious metals, where you're right, I'm thinking 20,000 gold by early next decade, probably 500 silver, 500 oil, copper will go through the roof. Natural gas, which has obviously been under tremendous pressure, we're going to have a shortage of energy out there, and natural gas will finally get that bid as well. So, maybe you'll see $50 natural gas. I don't know. These are bearish numbers because it's going to really hit pocketbooks. But for a short period of time of 2 or 3 or 4 years, you're going to be able to make a lot of money if you're in those areas. If you play it like you can just stay with your index portfolios that have done well since, as I say, anybody that bought an S&P index in the mid-'80s at the advice of a financial advisor proved to outpace most active institutional money managers through this time. And you can sit there and say, well, all I had to do was just put it in an index and it did it. I'm going to continue that. Indexes are going to get hammered because of interest rates in the next cycle. When rates go up, PE multiples go down. So the broad indexes are not going to do well in that environment. You will want to be in stocks that can outpace inflation. And that's the biggest sector for that is commodities. So, energy stocks could go up tenfold. Who knows? I mean, if oil goes from 30 to 500, there's going to be a lot of money made in the fossil fuel industry. If gold goes to 20,000, even a gold mining company is going to be able to produce results with that. So they've struggled even with gold moving as nicely as it has for the last couple of years. The gold mining companies have struggled. When you get the kind of moves you get in the metals, even poor managements can make money.
Yeah, I've seen it. I've seen it in my career, no question about it. David, you're awesome. I appreciate your fresh perspective on things. I definitely want to have you back and see how this all plays out. You're talking things start to unfold here by summer, so there'll be lots to come back and chat about. What's the best way for people to find out more about what you're doing? Of course, we'll make links and references to at the bottom of this. But what is the best way for people to keep on top of your analysis?
Yeah, there's 2 ways. I'm on Twitter every day or on X every day. And so my handle there is at Dave H. Contrarian. So make sure it's Dave H. I haven't seen it so much lately. Maybe the blue check helps. I don't know. But it used to be that lots of people would try to, you had these fraudulent accounts that would just change a letter in Contrarian or whatever and use your profile and your profile picture and makes it look like you. I've got 214,000 followers. So most of those fake accounts are lucky if they have 1,000 or 2,000 followers. So that's one way you can judge that it's me. The other thing I would tell people is I get often somebody will say, I haven't seen, you finally posted something. I haven't seen you in months. I go, I've probably posted just in the last week, 100 or 150 posts. You're missing it because you're only looking at original posts. Most of my communication is through replies to other people. So if somebody comments or asks a question, I'll answer them. And that's my dialogue through the day. Occasionally I'll put in an original post, but I just found when I do that, it opens me up to a world where I get a zillion posts out there, and I tend to want to answer my posts, so it gets so busy I can't do it. So I just have kind of done the replies is how I mostly communicate along with these interviews. So you have to make sure your settings are right so you're seeing replies, not just original posts. And then the other way I communicate is I have a quarterly investment letter that is by subscription, so there's a cost to it. Anybody that might be interested can direct message me on X, and I'll provide you details.
Wonderful. Yeah, that the fake accounts on X are a real pain in the butt. I seem to have to deal with that once or twice a week. And the process is kind of a pain in the butt to get it resolved. But nonetheless, I appreciate it very much, David. You're awesome. I look forward to picking up where we left off. I wish you and your family nothing but the best here in 2025. Thank you for jumping in with us here today, and we'll do it again real soon.
Yeah, thanks, Andy. I really appreciate it. And we should be in for some fun here in the next few months.
Yes, indeed. You know the old saying, may you live in interesting times. So
right.
These are indeed interesting. So thanks for sharing your perspective, David. It was very nice and refreshing to hear something different. So best of luck to you. Look forward to chatting with you again real soon.
Same to you. Thank you. Bye, Andy.
Little by Little with Andy Schechtman.